Why are top investors betting against the USA? A question that's been making the rounds, isn't it? You see, it's not as simple as it sounds. There's a notable shift taking place in the economic landscape. We're moving towards a more digital economy, a realm where traditional market boundaries are blurring and international markets are gaining traction. And it's not just about technology or innovation. It's about how the world is changing, how economies are evolving, and how investment strategies are adapting to these changes. As we delve deeper into this trend, we'll find that the answer is a combination of factors that have been brewing over time. The first signs of this trend emerged when investors started to diversify their portfolios. Let's take a look at a couple of examples that shed light on this shift. One of the most intriguing cases was GameStop, a video game retailer that was struggling to stay afloat in a market increasingly dominated by digital gaming platforms. The company's fortunes began to change when Ryan Cohen, the founder of Chewy, was appointed as the chairman of the board. Cohen advocated for a digital transformation of the company, a move that was met with an over 8% increase in GameStop's shares. The company also revealed plans to sell up to 3.5 million shares through an at-the-market offering, indicating a strategic shift towards a digital future and away from a traditional brick-and-mortar model. Meanwhile, another trend was emerging in a completely different industry. Sportradar, a data analytics company in the sports industry, started making waves. The company, backed by big names like Michael Jordan and Mark Cuban, was providing real-time statistics and game data to leagues and organizations worldwide. Sportradar was also supplying bookmakers with odds, live data, and managed trading services. With a valuation of $8 billion, the company was poised to tap into the burgeoning sports gambling industry, projected to be worth between $25 and $45 billion in the next decade. This shift towards non-traditional industries wasn't limited to digital gaming and sports gambling. It was also noticeable in the sphere of data analytics, with companies like Sportradar leading the charge. Despite losing an exclusive data deal with the NFL to Genius Sports Group, Sportradar seemed undeterred, setting its sights on maintaining a market share above 50% and continuing its growth in the global technology business. These cases signified a shift in investor interest towards non-traditional industries and international markets. The diversification strategies of investors were becoming more dynamic, more innovative, and more focused on harnessing the potential of digital transformations in various sectors. This was the beginning of a trend that would soon send ripples through the entire investment landscape. Wall Street's recent love affair with the Fed could turn on a dime. The Federal Reserve, or the Fed as it's commonly known, plays a critical role in the US economy. As the nation's central bank, it's tasked with making monetary policy decisions that can impact everyone, from the Wall Street investor to the average Joe. The Fed's primary tool for controlling the economy is through adjusting interest rates. When it raises rates, it's essentially making borrowing more expensive. This can slow down economic activity and cool off inflation. On the flip side, if the Fed lowers rates, it makes borrowing cheaper, which can stimulate economic growth. Recently, the Fed has been on a path of hiking interest rates to combat rising prices. This has a direct effect on investor sentiment. Higher interest rates mean higher borrowing costs for businesses, which can eat into corporate profits. This can, in turn, affect the stock prices of these companies, making them less attractive to investors. The recent trend of rate hikes has seen investors betting on an 84% chance that the Federal Reserve will hike interest rates by 0.75 percentage point at its meeting. Expectations for the December meeting were divided, with a 50% chance of a 0.75 point hike and a 43% chance of a smaller half-point hike. This uncertainty and the potential for higher borrowing costs have made investors jittery. There's a history here. Investors have previously rushed into markets on the belief of a Fed pivot, only to be met with a hawkish speech from Fed Chairman Jerome Powell that sent markets plummeting. This love-hate relationship between Wall Street and the Fed is nothing new. It's a dance that's been going on for years, with investors trying to anticipate the Fed's next move and position themselves accordingly. But it's a tricky dance, one that can lead to significant financial losses if investors get it wrong. With the Fed's decisions causing a stir, investors started to look elsewhere for opportunities. The IPO market has been slow, with only 2 companies going public in October, the slowest October since 2011. Now, let's delve deeper into this. An initial public offering, or IPO, typically signifies a company's growth, its readiness to take on the wider market, and most importantly, it's a method to raise capital. However, the recent years have seen a significant decline in the number of companies choosing this path in the US. In the past 12 months, we've seen a drop of over 80% in companies going public compared to the previous year. That's a significant slowdown from just 66 companies making the leap. But why is this happening? Well, the answer lies in the uncertainty and volatility of the market. High-profile unicorns, those privately held startup companies valued at over $1 billion, such as Instacart, Reddit, and Stripe, have reportedly delayed their plans to go public. This could be due to a multitude of factors, such as market conditions, interest rates, or the company's financial performance. But it's not just the companies themselves that are affected. This decline in the IPO market has significant implications for investors. The IPO market is traditionally seen as a barometer of economic health and investor sentiment. So, when fewer companies are going public, it can signal a lack of confidence in the market. This trend has further encouraged investors to look beyond the US for opportunities. The decline in the IPO market is one of the reasons why top investors are betting against the US. They're seeking opportunities in markets abroad, where there might be a more robust IPO scene. The decline in the IPO market has only added fuel to the fire, pushing investors to bet against the US. The question now is, how long will this trend continue? And what will it mean for the future of the US economy? Only time will tell. In conclusion, it's clear to see why top investors are betting against the USA. The financial landscape is shifting, and the signs are impossible to ignore. We've seen a diversification of portfolios as investors seek to maximize their returns and minimize their risks. Traditional industries are no longer the sole focus, with the rise of non-traditional sectors like e-commerce and sports data analytics. The story of GameStop's digital transformation and Sportradar ascendancy in the sports gambling industry underscores this trend. Both companies are examples of how innovative strategies and technological advancements are reshaping businesses and attracting investments. Moreover, the Federal Reserve's decisions have been a major influencer. The uncertainty surrounding interest rates has created a volatile market environment. Despite the recent gains in the Dow, Nasdaq, and the S&P, the potential for a sudden policy shift from the Federal Reserve keeps investors on their toes. The market's love affair with the Fed, as some might call it, could indeed turn on a dime, adding to the reasons why investors are hedging their bets. Lastly, the decline of the IPO market has been quite telling. With high-profile companies like Instacart, Reddit, and Stripe delaying their plans to go public and the slowest October for IPOs since 2011, it is evident that the traditional paths to raising capital are losing their appeal. While the USA remains a significant player in the global economy, these factors have led top investors to seek opportunities elsewhere, thus betting against the USA.